Imagine a digital dollar or maybe even a digital euro that promises, rock solid stability in the often pretty wild world of crypto.
Mhm.
But it's actually becoming much more than just a digital currency. It's really reshaping global payments, it's influencing national economies, and honestly, unlocking entirely new investment
Yeah,
avenues.
that's not science fiction anymore, is it?
Not at all. It's happening right now, and it's powered by something called stablecoins. Welcome to the deep dive.
Great to be here.
Today, we're going to try and cut through, the complexity of all the policy, the technology, the market
There's
dynamics.
a lot there.
Oh, there is, and bring you the strategic landscape and the incredible opportunities of stablecoins, looking out from 2025 to 2030.
A critical time frame.
Absolutely.
Yeah.
Our mission here is to deliver clear, actionable insights and, frankly, some surprising facts about how these digital assets are quietly becoming this fiercely contested foundational pillar of global finance.
And it's key to emphasize this isn't just about crypto anymore.
Exactly. It's really about the future of money itself.
As we're talking, we're looking at something like, what, $280 to $290 billion in stablecoin value circulating globally, mostly USD-pegged, right?
Overwhelmingly USD-pegged, yes. And what really started as kind of niche crypto plumbing,
Yeah.
the stuff needed to make crypto trading work.
Right, the behind-the-scenes stuff.
Exactly. That's rapidly accelerating its move into mainstream financial infrastructure. It's quite the shift.
Okay, let's really unpack this, because what's been happening with stablecoins, especially over the last year or so, has truly transformed their role.
He really has.
It's no longer just some obscure corner of the internet. It's becoming absolutely central to how money moves, how it settles, and even how it gets invested globally.
That's the key transition.
So we're going to explore these brand new regulatory frameworks, look at how major players think Visa, BlackRock, even Walmart are actively integrating them.
Household names, really. Yeah. And the profound macroeconomic and geopolitical implications, which are huge. And maybe most importantly, what does this all mean for you, whether you're running a business or just managing your own finances?
It's truly remarkable, actually, how quickly these digital assets, which, let's remember, were fundamentally designed for stability, have not just captured, but really demanded the attention of governments and major financial institutions all over the world.
It feels like they couldn't ignore it anymore.
Precisely. And when we connect this to the bigger economic picture, it really points to a profound and, I think, irreversible shift in how we perceive, use, and maybe even govern currency.
That period we're looking at, 2025 to 2030, feels like a real turning point.
It's absolutely a critical inflection point. This is where stablecoins transition from sort of theoretical potential to a concrete, regulated reality across pretty much every major economic bloc.
And that policy clarity that's emerging, that's not just helpful, it's actually making this mainstream adoption happen, isn't it?
It's enabling it. It's providing the rule book that these large institutions need to feel comfortable integrating these assets into their core operations. Without that clarity, you wouldn't see the kind of adoption we're talking about.
Okay, let's kick things off by really nailing down the terms. Because even for people who follow this space, the nuances around stablecoin are becoming critically important, especially with these new regulations.
That's a great starting point. Definitions matter immensely here.
So when we say stablecoin in this new era, what exactly are we defining? It sounds simple, but the details are everything now.
Right. So at its core, a stablecoin is a digitally native settlement asset. It's engineered, designed to maintain a stable value.
Okay, stable value. How?
Well, almost universally, that stability is achieved by pegging it one-to-one to a fiat currency. And as we said, the US dollar is by far the dominant peg.
So think of it like a digital dollar on a blockchain.
That's a very good way to put it. A digital representation of a dollar that lives and moves on these new rails. Its primary intended function, and this is really a crucial distinction now under regulation, is for payments and settlement.
Not for speculation like Bitcoin or Ether.
Exactly. Unlike those often volatile cryptocurrencies, stablecoins aim to give you all the benefits of blockchain. The speed, the transparency, the programmability, but without those wild, unpredictable price swings. Stability is the name of the game.
Right. So the stable part is obviously key, but what makes these specific stable coins different from, say, earlier attempts that maybe didn't work out so well or blew up spectacularly?
Ah, yes. Lessons learned there.
What's the fundamental design choice that regulators are really focusing on now?
That's the crucial differentiator. The stability isn't just some vague promise or a complex algorithm anymore. It's a structural mandate baked into the regulation,
Mandate, meaning?
meaning they are explicitly backed one-for-one by highly liquid real-world assets. Specifically, we're talking cash or short-term U.S. Treasury bills.
Held where? Not just anywhere, presumably.
Absolutely not. Held at supervised and regulated custodians. Think established banks or trust companies. This isn't just a company saying, trust us. It's a strict regulatory requirement.
Okay, so moving away from those algorithmic or crypto-backed models we saw problems with.
Precisely. Those models, unfortunately, proved fragile and carried significant risk. This move towards concrete, transparent, audited backing is exactly what's giving these newer stablecoins their legitimacy and making them usable in broader financial systems.
And this brings us neatly to the key regulatory classifications that have sort of solidified, especially post-2024, 2025. These really define the different types, right?
Yes, there's a very important split now.
The first category, and maybe the one most people will interact with directly, is what the analysis calls payment stablecoins.
That's right. These are your regulated fiat-backed stablecoins. Think of the big ones like USDC or PayPal's PYUSD, which has really expanded.
Right, PayPal getting involved was a big signal.
A huge signal. And even innovative state-issued coins like Wyoming's FRNT, which actually launched in 2025.
Wyoming, interesting. Leading the way there.
They often do in digital assets. So these payment stablecoins are characterized by strict adherence to comprehensive legal frameworks. In the U.S., that's the Genius Act, which came into effect July 2025. In the EU, it's the MiCA rules, which came into force in 2024.
Okay, Genius and MiCA, we'll probably hear those a lot.
You will. And a crucial, consistent rule across both these frameworks and globally really is that mandatory one-to-one reserve backing we just talked about.
Cash or T-bills?
Cash or short-term T-bills. And very notably, a complete prohibition on paying interest to the holders of the stablecoin itself.
Ah, okay, that's huge. No interest if you just hold, say, USDC in your wallet.
Correct. And this policy isn't an accident, it's very deliberate. These are designed purely as payment instruments, like digital cash, not as interest-bearing deposit accounts.
Why is that distinction so important to regulators?
It's absolutely fundamental to their regulatory treatment. The main goal is to make sure they function solely as a medium of exchange for payments and settlement, without directly competing with traditional bank deposits for yield. It's about maintaining financial stability and protecting the existing banking system structure.
So, if I'm getting this right, that no interest rule for payment stablecoins is a really significant policy choice. It shapes their entire function.
It absolutely does.
That means if you hold one, you're not earning anything on it directly, much like holding physical cash or, money in a very basic checking account.
That's the perfect analogy.
Yeah, that also implies there must be a different kind of digital asset that does offer yield to meet that demand.
Exactly. The market is clever, and it responded to this regulatory structure.
And that's where tokenized cash funds come in. And the analysis makes a really critical differentiation here.
The crucial one. These are not classified as payment stablecoins under these new regulations. That's key.
So what are they then?
Instead, tokenized cash funds are essentially on-chain shares of traditional money market funds, or MMFs, or perhaps treasury funds.
Okay, like investing in a money market fund, but the share itself is a token on a blockchain.
Precisely. Good examples are BlackRock's BUIDL fund or Franklin Templeton's BNG fund.
Big names there too. BlackRock. Wow.
Absolutely. Major players entering the space. Their key characteristic is that they do pay yield. They effectively pass through the interest earned from their underlying assets, typically those same U.S. Treasury bills or other high-quality short-term debt.
So the yield comes from the underlying assets, not the token itself pretending to be a deposit.
Exactly. They settle near instantly, which is a big advantage over traditional MMFs, but generally their distribution is carefully controlled.
Meaning, not just for anyone.
Typically, yes. They often move between whitelisted, qualified buyers or wallets. Think institutional investors, maybe accredited investors, depending on the fund and jurisdiction.
So this structure sounds like, well, almost a neat solution to the regulatory constraints.
It's a brilliant stroke of policy design and market innovation, frankly. It directly addresses that demand for yield from investors, which payment stablecoins are legally blocked from providing, while respecting and reinforcing those regulatory boundaries.
So maybe think of it like this. Payment stablecoins are like the digital cash in your wallet for spending, transferring, no interest earned just by holding.
Perfect.
while tokenized cash funds are more like a digital money market account for investing your digital dollars to earn yield, but likely with more restrictions on who can access them.
That's a fantastic way to summarize the distinction. It neatly separates the transaction utility from the investment opportunity, which is exactly what the regulations aim to achieve.
It's also probably worth just briefly mentioning what we're not focusing on in this deep dive. The analysis makes it clear that, the algorithmic stablecoins or the ones backed by other crypto,
Yeah.
those are largely out of scope now.
Yes, that's a crucial clarification. The market and the regulatory environment have matured, maybe been forced to mature, significantly after events like the LNA collapse.
Right, that sent shockwaves.
It did. The emphasis now is firmly on models that prioritize secure, transparent, and regulated, backing that 1.1 fiat, backing over more experimental or complex mechanisms that prove too risky. The goal now is undeniable, unshakable stability, not just speculative innovation in the stablecoin design itself.
And all this stability, this regulation, it leads us to maybe the most interesting part, the why now factor, this explosion in mainstream integration.
Yes.
It's not just that it's being adopted, but who is adopting it. We're talking household names using these for their actual core business. It really feels like the dam has broken.
It's truly remarkable to witness this integration happening across both retail and institutional financial rails simultaneously. You've got the major payment networks, Visa, MasterCard. They're actively wiring USDC and PYUSD settlement into their existing global networks. That's huge.
So using stablecoins behind the scenes to move money between banks or payment processors on their network.
Exactly. For things like settling with merchant acquirers, especially cross-border, then you have payment processors like Stripe, already supporting stablecoin acceptance for businesses using their platform.
Making it easier for online businesses to accept stablecoin payments.
Correct. And we mentioned PayPal significantly expanding its PYUSD stablecoin, making it much more widely available and usable.
And the big asset managers, BlackRock, Franklin Templeton, they're not just watching.
Not at all. They are actively operating these on-chain money market funds we discussed, BIDEAL, BNG functioning as these yield-bearing stable dollars for qualified buyers. That signals a really deep institutional embrace, moving beyond just payments.
And it's not just the financial players, even huge retailers are seriously looking at this, right? With real bottom-line motivations.
Absolutely. The analysis points out that giants like Walmart and Amazon are publicly exploring either proprietary stablecoins, their own branded coin, or perhaps joining a consortium to issue one.
Why would they do that? What's the driver?
It's not just curiosity. It's driven by a very powerful incentive, cutting those significant card transaction fees. We're talking 200 to 300 basis points, or 2-3% on potentially trillions of dollars in transactions.
It adds up to billions for them.
Billions,
Yeah.
easily. Plus, enabling instant settlement, getting their cash immediately instead of waiting days, and embedding highly programmable rewards directly into their payment systems.
Yeah.
Imagine dynamic discounts or loyalty points paid instantly.
This level of exploration from Walmart and Amazon, that's a monumental signal, isn't it? It could change everything from your grocery bill to online shopping.
It really could. It signals a massive potential shift in how transactions might be processed in the very near future. It's a core business strategy discussion for them now. And that surge in adoption we just talked about, from Visa integrating settlement rails to Walmart exploring its own coin, really underscores the why now of this moment.
Right, it feels like a tipping point.
Exactly. But this kind of mainstream integration, it just doesn't happen in a vacuum, does it? It absolutely demands a robust rule book.
You need guardrails.
You need guardrails. And that brings us perfectly to the global regulatory blueprint. We're really seeing a new era of oversight being forged right now, almost in real time.
And this period, 2024, 2025, feels like the key moment where it all started to crystallize.
Unequivocally, it's an inflection point where these foundational frameworks are moving from, fragmented proposals and discussion papers to actual enforceable laws, pretty much globally.
Okay, let's start with the United States federal approach. That seems to be leading the charge with a really significant piece of legislation, the Genius Act.
Indeed. The Genius Act, enacted July 2025, is truly landmark legislation. It's the first comprehensive federal regime specifically designed for payment stablecoins.
What does it actually do?
Well, it establishes national licensing requirements for what it calls permitted payment stablecoin issuers. So you need a federal license to issue these at scale.
And what do those issuers have to do?
They face stringent rules. They must hold those 1.1 reserves we talked about, cash or short-term USD bills. They have to provide monthly attestations of those reserves. verified by independent auditors.
So proving they have the backing consistently.
Yes, transparency and proof are key. They also need to maintain technical capabilities for freezing and blacklisting specific addresses, which is crucial for compliance.
For sanctions, anti-money laundering.
Exactly. Adherence to Bank Secrecy Act, BSA, and anti-money laundering AML standards is baked in. And crucially, remember the point from before.
No interest.
Exactly. The Genius Act explicitly prohibits these licensed issuers from paying interest to the stablecoin holders. Again, reinforcing that distinction. Payment instruments, not deposits.
Is there any room for smaller players or state-level initiatives?
Yes, there's actually a thoughtful provision. It allows state-regulated issuers, those with less than $10 billion outstanding, to opt in to federal oversight. This gives them a pathway to achieve broader legitimacy and potentially operate nationwide under consistent rules.
And the Genius Act isn't the only thing happening in the U.S., right? There's other related legislation.
Correct. The analysis mentions companion legislation like the Stable Act and the broader Clarity Bill. These are advancing other critical issues like clarifying the classification of different digital assets and refining market structure rules. It's a multi-pronged effort to create a comprehensive digital asset framework.
Now, I know the traditional banks have had, let's say, strong opinions on this. They've been quite vocal, haven't they?
They absolutely have, and understandably so from their perspective. They're actively lobbying to, as they put it, close yield loopholes. Meaning blocking any way stablecoins might indirectly offer yield or rewards that could lure deposits away from traditional banking. They have very real concerns about potential deposit flight.
How significant could that be?
Well, Treasury-linked analysis cited suggests that up to $6.6 trillion could potentially move out of traditional banks if stablecoins were broadly permitted to offer competitive yield. That's a staggering number.
Wow, that would definitely impact banks' funding costs.
Hugely. It would raise their funding costs and potentially constrain their ability to lend, which could impact the broader economy. And this brings us back to that core question. Why such stringent rules around interest and reserves?
Yeah. Why the hard line?
It's fundamentally about preventing systemic risk. It's about protecting the traditional banking system from potentially massive deposit displacement and thereby safeguarding the stability of the entire financial ecosystem. The legislative intent is clearly to carve out a distinct, non-competitive lane for payment stablecoins.
Makes sense from a stability perspective. Now, beyond the federal level in the U.S., states are also experimenting, aren't they? Showing some diversity in approach.
Yes, absolutely. On the United States front, Wyoming stands out again. They launched their Wyoming Stable Token, FRNT, back in 2025.
What's special about that?
It's a state-issued, dollar-backed token with very clear redemption mechanisms. It's effectively serving as a significant policy template for other states or subfederal entities thinking about issuing their own tokens. It shows states can be real incubators here.
Are other states doing similar things?
We're seeing exploration. Other states are looking into more niche sectoral tokens. For example, there have been proposals in Texas for oil-backed tokens. It indicates a sort of decentralized yet potentially quite impactful approach to digital currency innovation happening within the U.S. alongside the federal efforts.
Okay, let's hop across the Atlantic. How is the European Union handling this? MiCA has been talked about for ages as this groundbreaking framework.
MiCA, the Markets in Crypto Assets Regulation, is indeed a landmark piece of legislation globally. It really came into full force in 2024.
And how does it treat stablecoins?
It establishes comprehensive regimes for what it calls asset reference tokens, RATs, and e-money tokens, EMTs, which essentially cover different types of stablecoins. And very importantly, just like the U.S. Genius Act.
And let me guess, no interest.
You got it. MiCA also includes an explicit interest prohibition for holders of these stablecoins. This consistency really underscores that global regulatory consensus. These are payment instruments.
Are there any specific EU concerns, maybe about the dominance of the U.S. dollar?
Yes, definitely. The EU is actively debating and implementing caps and significant designations for non-euro tokens, especially large USD stablecoins like USDC.
Why the caps?
It's a key mechanism to contain potential dollarization within the Eurozone, to prevent displacement of the euro in digital transactions. It's about defending currency sovereignty and maintaining monetary policy effectiveness.
And is this pushing the EU towards its own digital currency?
Absolutely. In direct response to the growing clarity of U.S. policy and the sheer scale of USD stablecoins, the European Central Bank, ECB, has significantly accelerated its work on the digital euro. It's a strategic move to ensure the euro remains influential in the digital future.
Okay, and what about the United Kingdom? Often closely aligned, but sometimes taking its own path post-Brexit.
The UK is also moving decisively. The Bank of England, BOE, and the Financial Conduct Authority, FCA, are actively advancing their own frameworks, specifically targeting what they term systemic stablecoins.
Systemic meaning, too big to fail.
Essentially, yes. Stablecoins that could pose a risk to financial stability if they encountered problems. So the framework covers critical aspects like custody requirements, the quality of backing assets, and really detailed wind-down procedures in case an issuer fails.
Planning for the worst-case scenario.
Exactly. It's about putting them under stringent prudential guardrails. They're also going through consultations on integrating these into the existing payments infrastructure, positioning sterling-pegged tokens within a robust, closely supervised environment. They're aiming for stability and trust above all.
Makes sense. And let's look eastward now to Hong Kong and Asia more broadly. That region is often very forward-thinking in finance.
It really is. Hong Kong, for instance, saw its monetary authority, HKMA, pass a bill in May 2025. This established clear licensing requirements and reserve rules for fiat-backed stablecoins, very much focused on ensuring robust AML alignment as well.
So following a similar path to the US and EU.
Largely, yes. This follows earlier moves by Japan and Singapore, which had already set up their own e-money regimes that could encompass stablecoins. We also saw PayPal expanding its PYUSD support in the region in 2024, indicating growing demand.
And the elephant in the room? China.
Ah, yes. China's ambitions are significant here. They are actively debating launching a yuan-based stablecoin. This would exist alongside their massive eCNY push, the digital yuan CBDC, which had already processed over 7 trillion RMB in cumulative transactions by mid-2024.
A stablecoin and a CBDC. Why both?
It's strategic. The stablecoin could potentially operate more easily in international channels, perhaps via Hong Kong, offering a state-influenced but maybe less directly controlled alternative to the ECNY for global trade or finance, while still extending the yuan's digital influence.
Right.
It's about ensuring the yuan has a strong role in all digital channels globally, defending its currency sovereignty against the digital dollar.
Wow. Okay, that's a fascinating whirlwind tour of global regulations. It really sounds like every major economic bloc is scrambling to get a handle on this, maybe with slightly different flavors.
That's a good way to put it. Different flavors, different priorities sometimes.
But the one consistent theme, that through line, seems incredibly clear everywhere. Payment stablecoins are treated as payment instruments, specifically not interest-bearing deposits. That seems universal.
Absolutely. That policy coherence is really the bedrock for everything else that's happening. It means that while the nitty-gritty regulatory details might differ, the fundamental classification payment utility here, investment yield over there in tokenized funds, is a shared global principle.
And it's this clarity, even with all its complexity, that's letting the big institutions finally build on these things with confidence.
Precisely. They now understand the rules of engagement, the boundaries, and that's what's unlocking this wave of integration into the broader financial ecosystem we're seeing.
Okay, so we've laid out that crucial regulatory foundation. Now, let's talk about where these stablecoins are actually being used. This isn't just theory anymore. It's happening right now at scale in some really interesting sectors. First up, payments and merchant acquiring.
Yeah, this is arguably one of the biggest areas of immediate impact. It's really transforming the plumbing of global transactions.
How so?
Well, as we touched on, both Visa and MasterCard are actively integrating stablecoins like USDC and PYUSD into their settlement rails, primarily for acquirer payouts paying the banks that handle merchant accounts, and for cross-border settlement between different parts of their networks.
What are the benefits for Visa and MasterCard themselves?
The benefits are substantial. They can significantly cut down on existing cutoff times for processing transactions. And crucially, they can eliminate those annoying weekend and holiday liquidity gaps that currently plague traditional systems.
You mean where money just sits there stuck over a long weekend?
Exactly. Funds can sit idle for days. Stablecoins operating on 247 blockchains eliminate that entirely.
Where will we see this first? Behind the scenes?
Yes. The expectation is the first wave of implementation focuses squarely on that back end. Merchant settlement, treasury functions within the networks. Consumer checkout using stablecoins directly will likely follow, but it needs the wallet user experience to mature quite a bit, become much more seamless for the average person.
Still, just fixing the back ends is a fundamental upgrade for these payment giants, making money movement truly 24/7, 365.
It's a massive efficiency gain for them and their partners.
Imagine running an online business, getting your funds cleared instantly on a Friday night instead of waiting until Tuesday morning after a holiday weekend. That's huge for cash flow.
Absolutely enormous for small businesses especially. And speaking of businesses, the analysis highlights how even those retailers at the edge, the Walmarts, the Amazons, are deeply evaluating proprietary or consortium stablecoins.
We mentioned the motivation cutting fees, but how seriously are they looking at this?
Very seriously. Their motivation is incredibly clear and compelling. Compress those significant 200, 300 basis points in card fees they pay on every transaction.
Which adds up to billions.
Billions. Easily. Beyond cost savings, they also want that instant settlement we just discussed,
Yeah.
and the ability to embed highly programmable rewards. Think instant rebates, dynamic loyalty points, things like that, directly tied to the payment.
That could genuinely translate into savings for consumers or at least boost retailer margins significantly.
Potentially both. The strategic decision for them now is really about how to do it. Do they try to issue a stablecoin themselves, which means navigating all the tough obligations of the Genius Act or equivalent regulations?
Becoming a regulated financial entity, essentially.
Right, which is complex and costly. Or do they partner with an existing regulated issuer, leveraging their established infrastructure and compliance expertise?
It's that classic build versus buy dilemma.
Exactly, but played out on a massive scale with huge financial implications. If Walmart cuts transaction fees from, say, 2.5% down to maybe 0.1%, the impact is astronomical.
Okay, let's shift gears a bit. Cross-border B2B, remittances, and marketplaces. This feels like a really natural, almost obvious fit for stablecoins, given they're digital and borderless.
It absolutely is. Stablecoins enable truly 247 peer-to-peer settlement across a whole range of platforms. Think global online marketplaces, ad tech platforms settling payments between publishers and advertisers, gig economy platforms paying international workers, even trade finance documentation and settlement.
What about corporate treasuries? How does it help them?
For corporate treasury teams managing cash globally, it's a game changer. They can pre-fund far less cash in various accounts, anticipating weekend or holiday closures, reducing idle capital. They can also minimize leakage from foreign exchange spreads by programmatically hopping between different stablecoins or blockchains to find the cheapest, fastest route for a specific payment in real time.
That sounds incredibly efficient.
It is, and the real-world impact is already visible in areas like humanitarian aid. We've seen successful pilots from the UNHCR and corridors built by companies like Stellar and MoneyGram, demonstrating large-scale cash-in, cash-out disbursements using USDC in really challenging environments where traditional banking is weak or non-existent. Aid gets there faster and cheaper.
So connecting this back to the bigger picture, it's really about making global commerce faster, much cheaper, especially for smaller players, for remittance users, for anyone operating across borders and time zones.
That's the core value proposition.
But this naturally raises the question, what does this do to traditional correspondent banking? You know, the old system of banks having relationships with other banks overseas to move money. Are stablecoins slowly eating their lunch?
That's a very pertinent question and a sensitive one for the banks. Stablecoins certainly offer a compelling alternative that bypasses a lot of the friction, the delays, the opaque fees associated with correspondent banking.
It feels much more direct.
It is.
Mhm.
While they might not entirely replace correspondent banking overnight, especially for complex transactions, they undeniably introduce significant competitive pressure. It's forcing traditional banks to innovate, to become much faster and cheaper in their own cross-border services.
Adapt or risk being sidelined.
Pretty much. It's a clear signal that the landscape is evolving incredibly rapidly, and legacy players have to adapt to this new digital reality or risk losing significant chunks of business, particularly in high-volume, lower-value payments and remittances.
Okay, next area, capital markets and DeFi plumbing. How are stablecoins fitting into the more complex, high-stakes world of institutional finance and, decentralized finance?
They're becoming pretty fundamental plumbing there, too. In the crypto-native world, stablecoins are already the default margin currency on most major exchanges. They're the base asset used for collateralizing trades, futures, leverage.
The standard unit of account for trading crypto.
Exactly. And increasingly, they're entering tokenized collateral workflows within traditional capital markets as well, used as collateral for repo transactions or other secured financing, albeit still on a smaller scale.
And those tokenized money market funds we talked about, BUIDL and BNN.
Yes, they fit right in here. They offer qualified institutional investors that crucial intraday liquidity. They can get their cash same day. unlike traditional MMFs and programmable settlement features, all within those carefully controlled, whitelisted wallet environments.
So institutions get the yield of an MMF, but with the speed and programmability of the blockchain.
That's the appeal. It streamlines processes like cash management, collateral posting, things that traditionally take days, down to minutes or seconds.
And finally, a really innovative area you mentioned, loyalty, rewards, and programmable commerce. This sounds like it could genuinely change how we think about discounts and loyalty programs.
I think it really could. Retailers can now issue highly programmable coupons or rebates that settle directly in stablecoins.
What does that enable?
Well, imagine loyalty points that aren't stuck with just one brand. Because they're stablecoins, they could potentially become universal, maybe even tradable, breaking free from those siloed, restrictive loyalty programs we all have dozens of.
Interesting, like actual cash equivalent rewards.
Potentially, yes. It also allows for real-time funding for merchants participating in coalition loyalty programs, which is a big plus for their cash flow. Now, it's really important to clarify something here.
The interest rule again.
Exactly.
Huh.
Cashback rewards or discounts that are directly tied to spending are generally considered outside the definition of interest that's prohibited by Genius and MiCA.
Ah, okay. So spend $100, get $5 back in stablecoins is okay, but hold $100 in stablecoins, get 1% interest is not okay for a payment stablecoin.
That's the crucial distinction. It's a clever line drawn by regulators that still allows for significant innovation in loyalty, dynamic pricing, and promotional activities without letting payment stablecoins become deposit competitors.
Okay, let's pull back even further now and look at the really big picture. How are stablecoins starting to impact global economies and even geopolitics? The analysis uses a fascinating term, dollarization 2.0. What does that mean?
Dollarization 2.0 refers to the way USD-pegged stablecoins are profoundly extending the reach and influence of the US dollar, especially penetrating into jurisdictions with strict capital controls or those suffering from high inflation.
Thinking places like Turkey, Nigeria, Argentina, maybe?
Exactly. Places where the local currency can be extremely volatile and unpredictable, and people are desperately seeking a stable store of value. Stablecoins provide a digital, relatively easy-to-access way for ordinary people and businesses in those countries to hold dollar-denominated value.
Easier than getting physical dollars, perhaps.
Often much easier, faster, and cheaper to acquire and use for transactions. The impact is quite significant.
Yeah.
It deepens the informal usage of the dollar within those economies and can actually reduce the velocity, the circulation speed of the local currency.
Which has big implications for their central banks trying to manage monetary policy.
Huge implications. Now, traditional banks or payment rails in those countries might see this as cross-border leakage, capital flowing out digitally. But for consumers and small businesses on the ground,
It's a lifeline.
it can be a vital form of financial stability they might otherwise completely lack. It gives them access to dollar savings and payments with an ease and speed that physical dollars smuggled or hoarded could never offer at scale.
So this dollarization 2.0 isn't just a tech upgrade. It's like a quiet revolution, giving individuals in volatile economies a readily accessible, borderless digital safe haven.
That's a great way to put it.
And it potentially sidelines their own central banks, reshaping the fabric of their national economies in a way physical dollars couldn't achieve so easily. It feels like a fundamental challenge to monetary sovereignty.
It absolutely is. It introduces this parallel digital economy operating largely in dollars, which can be empowering for individual financial freedom, yes,
Yeah.
but incredibly challenging for national central banks trying to manage their own currency and maintain control. It forces a real reevaluation of what national monetary authority even means in an increasingly borderless digital world.
Wow. Okay, speeder of banks again. The analysis talks about bank funding and credit intermediation, and there's a very clear warning coming from the traditional banking sector about stablecoins.
There is, and it's quite emphatic. Banks warn that if payment stablecoins reach significant scale, remembering they are zero-interest liabilities for holders, but the issuers earned interest on the T-bill reserves backing them.
Right, that profitable spread for the issuer.
Yes, if enough money flows into them, they could significantly displace traditional bank deposits.
People moving money out of savings accounts into stablecoins, even without direct interest, maybe for payment utility or access.
Or maybe indirectly trying to access yield through other connected DeFi applications, even if the stablecoin itself pays nothing. If this happened on a massive scale, banks argue it would inevitably raise their own funding costs. They'd have to pay more to attract or retain deposits.
Which could make borrowing more expensive for everyone.
Potentially, yes. It could impact their ability to extend credit throughout the economy. We mentioned that Treasury-linked analysis pegging potential outflows in the trillions if yields are broadly allowed.
Right, the $6.6 trillion figure.
Exactly. And this is precisely why we see those explicit interest bans in the U.S., Genius Act, and EU, MiCA. They serve as a critical protective measure designed specifically to prevent stablecoins from destabilizing the traditional banking system's funding model.
It seems stablecoins are also having a noticeable impact even now on the demand for certain financial assets, specifically safe asset demand and yields.
That's right. It's quite fascinating. Research from the Bank for International Settlements, BIS, has actually found a measurable effect.
What did they find?
They found that significant inflows into stablecoins, meaning more people buying stablecoins, whose reserves are then invested mostly in T-bills, can demonstrably lower the yields on short-term, like 3-month U.S. Treasury bills
By how much?
by approximately 2 to 2.5 basis points within just 10 days of those large inflows. There's also an asymmetry. Rapid outflows from stablecoins can tighten yields, push them up even faster. So more demand for stablecoins means more demand for T-bills, which pushes their price up and yield down slightly. That's the mechanism. The net effect is that a growing stablecoin market generally leads to marginally cheaper funding for the U.S. government. And conversely, a sharp contraction in the stablecoin market could slightly increase government borrowing costs.
Yeah.
It shows just how interconnected these markets are becoming.
Wow. Okay, and what about the biggest geopolitical game of all? How do stablecoins affect the USD reserve status and currency sovereignty on the global stage? Is this reinforcing the dollar's dominance?
The prevailing view is yes, at least for now. A regulated, scalable layer of USD-denominated stablecoins effectively reinforces the US dollar's primacy in global digital commerce. It extends the dollar's reach and utility into this new digital realm, offering a modern, efficient channel for its existing global dominance.
So it's like upgrading the dollar for the internet age.
In a way, yes. And this strategic advantage, or perceived advantage, has directly prompted other major economic blocs to respond forcefully with their own digital currency initiatives.
Like the digital euro acceleration we talked about.
Exactly. The EU accelerating the digital euro is partly a defensive measure to defend the euro sovereignty in digital channels and prevent the eurozone from becoming excessively dollarized through stablecoins.
And China's moves.
Similarly, China's exploration of a yuan-based stablecoin alongside its huge ECNY efforts is clearly aimed at securing the yuan's monetary influence in the coming decades. They don't want to be left behind or see the digital world run entirely on dollar rails.
So it's fascinating. A stablecoin started as this niche crypto innovation, almost a technical tool.
Right, just for traders initially.
And now they're a central battleground for global currency dominance. If you connect that to the bigger picture, it really highlights this intense race among major economies to define their digital monetary future and secure their influence.
It's become a major geopolitical issue, absolutely.
Finally, in this section, let's touch on sanctions and compliance reach. This feels like an area where regulated stablecoins could significantly extend the power of governments and regulatory bodies.
Absolutely. It's a key feature and a requirement of the regulated environment. Issuers of permitted stablecoins, like USDC or PYUSD, are explicitly mandated to maintain those blacklist and freeze functions we mentioned.
Meaning they can block specific addresses from sending or receiving funds.
Correct. And they respond diligently to requests from authorities like the U.S. Treasury's Office of Foreign Assets Control, OFAC, or the Financial Crimes Enforcement Network, FinCEN. This effectively extends U.S. jurisdictional leverage deep into the digital asset space, allowing for more granular, real-time enforcement of sanctions and anti-money laundering policies globally.
That sounds like a powerful tool for enforcement.
It is. However, there's an important flip side, or maybe an unintended consequence. This enhanced control and surveillance capability can inadvertently push some users, those seeking to evade such oversight, for legitimate or illicit reasons towards less regulated stablecoins, offshore exchanges, or entirely decentralized, hard-to-control venues.
So it creates this kind of cat and mouse dynamic.
It does. It's a continuous challenge. Balancing effective enforcement within the regulated system against the risk of driving unwanted activity into the shadows, completely outside the regulated perimeter. It's a delicate tightrope regulators have to walk.
Okay, this is a really critical question. If payment stablecoins aren't paying interest to holders, who exactly is making money from this rapidly growing market and how? Let's try and break down the economics, starting with the payment stablecoin issuers themselves, like Circle USDC or Tether USDT or PayPal. PYUSD.
Right. For these issuers of payment stablecoins, their primary revenue model is straightforward. It's the interest they earn on their underlying reserves.
The cash and T-bills they hold to back the coins.
Exactly. As we've established, these reserves are predominantly held in highly liquid, safe assets, like cash deposits or short-term U.S. Treasury bills. They essentially profit from the interest rate, spread the difference between the zero yield they offer on the stablecoin liability itself and the positive yield they earn on the assets backing it.
So higher interest rates are generally good news for them.
Very good news. Their profitability is highly sensitive to prevailing short-term interest rate cycles. And of course, it's also driven by the sheer growth in their stablecoin circulation. The more coins outstanding, the larger the reserve pool earning interest.
Are there other revenue streams too?
Yes, although typically smaller. Things like float timing, benefiting from the brief period before funds fully clear during issuance or redemption, and potentially various network fees or API fees charged to enterprise clients who use their stablecoins for treasury operations or payouts.
And have these profits been significant?
Hugely significant, especially in recent years with higher interest rates. Tether, for example, reported truly remarkable profits, $13 billion in 2024, and $4.9 billion just in Q2 of 2025. Circle, the issuer of USDC, while preparing for an IPO, disclosed revenues around $1.7 billion in 2024, with something like 99% of that coming directly from income generated by its reserves.
Wow. So that interest spread is really the core engine. It's a key insight. While you, the holder, don't get interest, the issuers are potentially making substantial profits from it.
That's the fundamental business model for regulated payment stablecoin issuers.
But they also operate under some pretty significant constraints now because of those regulations we discussed.
It's not just free money. They face substantial regulatory and operational burdens. As dictated by the Genius Act in the U.S. and MiCA in the EU, that prohibition on paying interest to holders is ironclad. They have to undergo rigorous stress testing to prove they can handle market shocks. They're subject to those mandatory monthly attestations of their reserves by independent reputable auditors, which costs money and requires transparency. And they must maintain those robust freeze and blacklist capabilities for compliance, which adds technical and operational complexity.
And this strict regulatory environment probably opens the door for more competition, too, from traditional players.
It certainly does. Traditional banks, for example, are looking very closely at this space. They might enter either as issuers themselves, perhaps launching their own branded stablecoin, or offering white-label stablecoins for their corporate clients.
Or they could play a different role.
Or they could become crucial reserve managers or custodians for existing stablecoin providers. By managing the underlying cash and T-bills, they could capture a significant share of those valuable fee streams and potentially some of the interest income without taking on the full burden of being an issuer themselves. Competition is definitely heating up.
Okay, that sets up the next category perfectly. Tokenized fund providers, those offering the on-chain money market funds, or T-bill tokens, like BlackRock's BUIDL or Franklin Templeton's BenNG. This is where the yield that payment stablecoins can't offer actually goes, by design.
Precisely. This is the regulated channel where the market's demand for yield on digital dollars effectively migrates. On-chain MMFs, like BUIDL and BenNG, are specifically structured to pay daily dividends, passing through the interest earned from their underlying treasuries or other debt instruments directly to their whitelisted, qualified wallets.
So they provide that compliant way for investors, maybe institutions, maybe accredited individuals, to earn yield on digital dollars.
Exactly. It's a distinct product, regulated differently, targeting investment rather than just payment. And we anticipate truly significant growth potential in this specific sector.
How significant?
Projections suggest we could see $5 billion to $10 billion, maybe even more, in monthly net inflows into these types of funds, especially if access eventually broadens beyond just institutions to include retail and SME investors through brokers or neobanks where regulations permit. It's a clever, regulated bypass for yield capture.
And beyond the direct issuers and the fund providers, there's a whole ecosystem of other players enabling this and potentially profiting, right? What the analysis calls networks and enablers.
Absolutely. It takes a village, as they say. Think about the card networks like Visa and MasterCard. As we mentioned, they're starting to take transaction fees or take rates on stablecoin settlement flowing through their rails. This generates new cross-border revenue for them, and it also makes their relationships with merchant acquirers much stickier because they're offering faster, more efficient settlement options.
What about the retailers? Walmart, Amazon, others. How do they potentially profit or benefit?
Immense potential for them, primarily through lower merchant discount rates, MDRs, avoiding those 2–3% card fees. Plus, getting instant access to their cash improves working capital dramatically. And then there's the ability to implement those highly programmable loyalty programs we talked about.
Could they earn float on wallets, too?
Potentially, yes.
Yeah.
If they encourage customers to hold balances in proprietary or partner wallets, they might earn float on those balances, though this would likely be subject to very stringent regulation, possibly treating them like money transmitters or requiring specific licenses. Again, that build versus partner decision is key for them.
And then there's all the underlying infrastructure needed to make this work.
Right. A whole ecosystem of infrastructure providers is springing up and monetizing this burgeoning enterprise adoption. This includes specialized custodians securing the digital assets, firms providing sophisticated KYC/ML analytics tailored for blockchain transactions, secure key management services, compliance oracles that feed real-time regulatory data or sanctions list updates into smart contracts, and of course, the crucial on-off ramps that allow users to seamlessly convert fiat currency into stablecoins and back again. Every single piece of this infrastructure represents a business opportunity in this growing space.
Okay, let's shift our gaze towards the horizon now. The analysis provides some really fascinating scenario analysis for how stablecoins might realistically evolve between now, 2025, and looking out towards 2030. Let's start with the base case, what's seen as the most likely trajectory.
Right. In the base case scenario, the expectation is that these robust regulatory frameworks we've discussed, primarily the U.S. Genius Act and the EU's MiCA, will really become the anchors for global norms. They'll provide a reasonably consistent operational environment that fosters trust and allows for steady growth. And what does that growth look like?
USD stablecoins are projected to continue growing significantly, maybe at a compound annual growth rate, CAGR, somewhere in the range of 20–35%. We'll likely see them increasingly migrate onto faster, lower-fee Layer 2 scaling solutions for Ethereum, or perhaps directly onto other high-throughput blockchains like Solana, simply to handle the massive transaction volumes efficiently.
And what about the yield side?
The tokenized MMFs, like BUIDEAL and BenNG, will continue to grow and effectively absorb the market's demand for yield, operating within their own distinct, regulated investment fund frameworks.
How will retailers and banks fit in?
We'll probably see most major retailers choosing to adopt partner-issued stablecoins, leveraging existing regulated issuers, rather than going through the complexity of issuing their own. And traditional banks will likely play that crucial dual role, managing the reserves for stablecoin issuers, capturing fees there, and perhaps issuing white-label stablecoins for their corporate clients who want the benefits without the operational burden. So this base case sounds like, well, controlled, regulated growth. Integration rather than disruption.
Exactly. It paints a picture of stablecoins becoming deeply embedded within the existing financial system, under clear rules, augmenting it rather than completely overturning it.
Okay, that's the base case. But what about a more interventionist approach? The analysis outlines a scenario for a potential U.S. official coin, maybe a public-private partnership.
This is an interesting alternative scenario. It posits that the U.S. Treasury and the Federal Reserve could potentially authorize a specific government-backed payment token. It wouldn't necessarily be a full retail CBDC, but a token issued and operated via licensed private sector companies.
How would that work financially?
In this model, the interest generated from the underlying reserves wouldn't go to the private issuer. It would flow directly to the U.S. Treasury. Traditional banks would likely still play a role, probably serving as the crucial reserve agents holding the assets.
What would be the rationale for this approach?
It would maximize direct policy control for the government. They'd have complete oversight and capture the revenue generated from the reserves. However, it's important to stress.
It's less likely than the base case.
Currently, yes. Congress, particularly through the framework established by the Genius Act, seems to favor private issuance under strong federal oversight. And a true retail CBDC available to everyone remains politically contentious and off the table in the U.S. for the foreseeable future. So this official coin is a distinct possibility, but perhaps less probable than the private sector-led base case.
Understood. Now, thinking about that global competition for currency dominance we discussed, what about a non-USD pushback scenario? How might other nations actively counter the rise of the digital dollar?
This scenario envisions more assertive responses from other major economies. We could see the EU not just accelerating its digital euro program, but perhaps implementing stricter caps or maybe even interchange fees on the use of non-euro stablecoins for payments within the Eurozone. really trying to protect its currency sovereignty and actively promote the digital euro's adoption.
And China.
Concurrently, we might see a state-influenced CNY stablecoin emerging, likely channeled through Hong Kong initially. It would be carefully tethered to China's onshore reserve rules, but could operate more flexibly offshore than the eCNY itself.
Offering a state-backed alternative to USD stablecoins for international trade or Belt and Road initiatives, perhaps?
Exactly. It would serve as a powerful instrument to extend the yuan's digital reach globally, potentially with slightly different optics or controls than a pure CBDC. This scenario really highlights that ongoing, intensifying geopolitical competition playing out in the digital currency arena. National interests become paramount.
Okay, those are different potential paths. But every system, especially a financial one, has vulnerabilities. What's the nightmare scenario? The stress case, the tail risk outlined where things could potentially go very wrong.
Right. The stress case describes a scenario involving a major depeg event where a large stablecoin loses its 1.1 peg to the dollar, or perhaps a sudden massive run where holders rush to redeem their coins en masse.
Like a digital bank run.
Precisely. If this happens suddenly and at scale, it could force the issuer into an intraday fire sale liquidation of its underlying treasury bills to meet redemption demands.
What would be the consequence of that?
Selling huge amounts of T-bills very quickly could potentially disrupt the short-term funding markets, leading to a sharp, sudden spike in short-term interest rates across the broader financial system. The BIS, the Bank for International Settlements, explicitly flags this as a critical tail risk scenario that needs careful management.
How would the system respond to such a crisis?
In response, you'd likely see pre-planned mechanisms kick in. Emergency liquidity facilities from central banks, perhaps, automatic circuit breakers to temporarily halt trading or redemptions, and potentially emergency redemption gates limiting outflow amounts to manage the run and prevent wider contagion.
This scenario really underscores why those strict regulations around reserves, liquidity, and operational resilience are just so incredibly important.
Absolutely paramount. It's about building in robust, tested safeguards, learning from past financial crises and recent crypto meltdowns to mitigate these inherent risks, especially as stablecoins become potentially systemically important and deeply interconnected with traditional markets.
It really raises the question, how truly robust are these systems under extreme stress? It seems like constant vigilance and testing are needed.
Continuous vigilance, ongoing refinement of regulations, and proactive stress testing are absolutely key. Regulators are demanding that issuers model and prepare for these kinds of severe, adverse scenarios to ensure the system can withstand shocks.
And to wrap up this section on the future, let's quickly map out the key risks and the controls being put in place to manage them. You've touched on some already.
Right. The primary concern, as we just discussed, is depeg and run risk. This could be triggered by various things. Liquidity holes if reserve assets suddenly become hard to sell, operational failures at the issuer or a key custodian, unexpected legal actions.
And the control.
Strict asset composition is number one, mandating only ultra-liquid cash and short-term government securities, primarily T-bills. Daily net asset value NAV monitoring to ensure the 1.1 backing holds. Those mandatory monthly attestations by independent auditors. And comprehensive stress testing protocols designed to ensure they can handle severe market shocks or redemption waves.
Okay, what's next on the risk map?
Bank funding and systemic feedback. We covered this, the risk that large-scale deposit migration from banks to stablecoins could tighten credit conditions. Controls here involve regulatory oversight, potential holding limits if needed, and closely monitoring the interlinkages between stablecoin markets and traditional finance to prevent adverse systemic impacts.
Then there's the compliance aspect.
Yes, sanctions AML and freeze risk. While the freeze capability is a necessary compliance tool for regulated issuers, it also represents a risk for users. Their funds can be frozen if their address is linked to illicit activity or sanctions lists. So users need to understand they're operating in a compliance-aware environment.
What about the different rules in different places?
That's jurisdictional fragmentation. The varying regulatory approaches EU limits on non-euro tokens, specific UK systemic oversight, the US federal versus state dynamics, mean that stablecoin products and services have to be designed to be highly geo-aware. What's permissible in one region might be restricted or illegal in another, requiring adaptable strategies and potentially limiting global seamlessness.
And finally, the tech itself.
Technology chain risk. This covers a range of threats. Vulnerabilities in the smart contracts, exploits of the bridges connecting different blockchains, major blockchain outages or reorganizations, or compromises of the private keys that control the funds.
How are these mitigated?
Mitigations involve robust security audits, using multi-signature or multi-party computation (MPC) custody solutions to avoid single points of failure, deploying stablecoins across multiple blockchains (multi-chain architecture), and for some products like the tokenized MMFs, using tightly controlled transfer lists or whitelists to limit who can hold or transact the tokens. These controls collectively aim to build an incredibly resilient, secure, and trustworthy ecosystem.
Okay, this is where we bring it all home. We've journeyed through the definitions, the complex web of regulations, the compelling real-world uses, the potential futures, and the inherent risks. Now, the crucial question. What does this all mean for you? Let's start with an actionable playbook for businesses, whether you're a major bank, an agile fintech, a global retailer, or a large enterprise with complex treasury needs.
Right, let's get practical. For banks, the decisions are strategic and pretty immediate. First, decide on your role. Do you want to actually issue a stablecoin? Maybe alone, maybe partner in a consortium with other banks. Or do you position yourself differently?
As a service provider to the issuers.
Exactly. Focus on being a critical reserve manager or custodian partner for existing stablecoin issuers, earning fees that way. Regardless of the path, building Genius compliant or MiCA compliant, etc., technology is non-negotiable. This includes having the required freeze capabilities, robust attestation processes, seamless APIs for clients.
What services should banks offer?
Offering sophisticated client treasury modules will be key. Think tools that allow corporate clients to easily manage digital dollar holdings. Maybe automate intraday sweeps between non-interest-bearing payment stablecoins for transactions and yield-bearing tokenized MMFs for overnight investment. That's a high-value service.
Okay, what about card networks, payment service providers, PSPs, and retailers? Seems like huge opportunities there.
Monumental opportunities. They should be aggressively rolling out stablecoin settlement options, especially for specific use cases initially. Think high chargeback categories where instant settlement reduces risk, definitely cross-border sales to cut FX costs and delays, and enabling weekend cash flow for merchants who desperately need it.
And the programmable rewards.
Absolutely. Pilot programmable rewards programs, and this is critical with careful legal review to ensure they structure them as discounts or rebates tied to spending, clearly avoiding anything that could be construed as prohibited interest under Genius or MiCA.
Should retailers go it alone or partner up?
Retailers, particularly larger ones, should seriously evaluate joining or forming merchant consortiums, probably partnering with a regulated issuer. This allows them to benefit from shared infrastructure, pooled liquidity, and significantly reduced transaction fees without having to become regulated issuers themselves.
Right.
Imagine small online businesses cutting those 2–3% card fees down to fractions of a percent that's real, tangible money back in their pockets instantly.
So it really isn't just for the tech giants or specialized crypto firms. There are concrete, practical steps for established financial institutions and even everyday businesses to adapt and genuinely benefit from this fundamental shift in financial plumbing.
Absolutely. For asset managers and brokers, the clear opportunity is in distributing those tokenized cash funds, MMFs, T-bill funds we discussed, packaging them with retail-friendly wrappers or interfaces where regulations permit, will be key to broadening access beyond just institutions.
What about facilitating movement between the types?
Yes, offering things like atomic swaps, instantaneous exchanges between tokenized MMFs and payment stablecoins could be very valuable. Allowing clients to keep funds earning yield until the very last second before they need to make a payment, then swapping just the required amount instantly. That's powerful cash management.
And for large enterprises with global operations.
For enterprises dealing with global accounts payable, AP, and accounts receivable, AR, adopting USD stablecoins can dramatically streamline things. Using them for faster supplier prepayments, more efficient treasury sweeps between international subsidiaries, cutting FX costs and delays, it all adds up.
What infrastructure do they need?
They'll need to standardize on robust, likely multi-chain or chain-agnostic digital asset wallets that come with strong policy controls, defining who can approve transactions, setting spending limits, and integrated address screening tools to ensure compliance with sanctions lists and AML regulations. Managing this securely at scale is vital.
Okay, that's the business side. Now let's talk directly to you, the listener. What are the opportunities for individual, non-accredited investors or just everyday users? This is where many people might be curious, but also cautious about how to participate safely and smartly.
Yeah, and caution is wise. It's absolutely critical to preface this by saying that regulatory availability and specific product offerings can vary significantly depending on where you live. So always check your local rules and only use regulated platforms.
Understood. So for basic cash management, just holding digital dollars for transactions.
For transactional balances, if you choose to use stablecoins, stick to the highly reputable payment stablecoins issued by entities clearly regulated under frameworks like the U.S. Genius Act or the EU's MiCA. Look for issuers who provide those transparent monthly attestations of reserves, clearly disclose their banking partners, and demonstrate robust procedures for compliance, including blacklisting.
And remember the golden rule.
And remember the golden rule. These payment stablecoins are not for earning yield. Their value lies purely in their utility for fast, stable, potentially cheaper payments and transfers. Don't expect to earn interest just by holding USDC or PYUSD.
Okay, but what if someone is looking for yield on their digital dollars, safely and legally?
That's where the regulated path points towards on-chain T-bill exposure via those tokenized MMFs. Access for individuals might come through brokered platforms or apps that integrate with funds like Franklin Templeton's BNJ, perhaps allowing conversion from USDC into the yield-bearing fund token.
But availability might be limited.
Availability will likely be limited by jurisdiction and potentially require going through regulated brokers or investment platforms that are authorized to offer these fund products to retail clients. This is the compliant way non-issuers can legally pass through the yield earned from underlying assets like T-bills.
What about more advanced, maybe riskier strategies?
For more sophisticated users, and again, this comes with much higher risk, there's cross-venue arbitrage in funding markets. This might involve things like basis trading, capturing small price differences between spot stablecoins and futures contracts, using stablecoins as portable collateral across different exchanges, or playing the funding rate spreads on perpetual swaps.
But this isn't for beginners.
Absolutely not. This requires a deep understanding of market mechanics, exchange risk, counterparty risk, the risk that the exchange itself could fail, and it's definitely not suitable for most individuals. You must understand and be comfortable managing these significant risks.
Another area often discussed in DeFi is liquidity provision. Can individuals earn yield that way with stablecoins?
Yes, providing liquidity to trading pools on exchanges either centralized CEX or decentralized DX can be a source of yield. Typically, for lower risk, people focus on high-quality pools, often pairing one stablecoin against another, like USD and CUSDT, to minimize impermanent loss.
Explain impermanent loss quickly.
It's basically the risk that the value of your deposited assets diverges while they're locked in the pool, meaning you might have been better off just holding the original assets. Stable-to-stable pairs minimize this because their prices shouldn't diverge much. The returns here come from earning a share of the trading fees generated by the pool, plus potentially extra token incentives offered by the platform.
But there are still risks.
Oh yes. Smart contract risk is always present in DeFi. The risk that the code underlying the pool gets hacked. Platform risk is there too. Again, this is not for the faint of heart or those unfamiliar with the intricacies and risks of DeFi protocols.
What about merchant acceptance for small business owners listening?
Yes, for small and medium-sized enterprises, SMEs, actively choosing to accept stablecoin payments can be a direct way to benefit. It can significantly reduce transaction fees compared to cards, potentially lower chargebacks because blockchain transactions are harder to reverse, and dramatically speed up access to working capital.
So their profit is really cost avoidance and efficiency gains.
Exactly. Cost avoidance plus the immense value of faster cash flow. We're already seeing pilots from Stripe, Visa, and MasterCard, making this easier for merchants to adopt.
And lastly, the more speculative side.
Lastly, there's always the potential for airdrops and ecosystem rewards. Historically, platforms and protocols have sometimes rewarded early users of their systems, new wallets, new Layer 2 networks, compliant platforms with free tokens as an incentive. This is purely speculative, you can't count on it, but it has occasionally been quite material for early adopters who engage with these new regulated ecosystems.
So clearly many potential avenues opening up, but it seems crucial to constantly reiterate the expectations, especially around yield.
Absolutely critical. Let's be crystal clear again. What not to expect is earning interest directly from the issuers of payment stablecoins themselves. That door is now firmly closed by regulation in major jurisdictions like the US and EU.
So if you're seeking yield on digital dollars,
If you're seeking yield, it needs to come from other distinct sources. Either regulated investment fund products, like the tokenized MMFs we discussed, or through active participation in market activities like liquidity provision or lending on regulated platforms, each of which carries its own specific set of risks, eligibility requirements, and compliance considerations.
This naturally leads to the question, how can individuals navigate all these new opportunities safely and effectively? It feels complex.
It is complex, and navigating it safely requires understanding that evolving regulatory landscape we've spent so much time discussing. It requires understanding the inherent risks, technical risk, market risk, counterparty risk associated with each specific product or activity.
Due diligence is key.
Personal due diligence is absolutely paramount. When we connect this to the bigger picture, it heavily emphasizes choosing providers, platforms, and assets that adhere to the highest standards of transparency, security, and compliance, rather than chasing unsustainable high yields often found in unregulated corners of the market. Safety and compliance have come first in this new era. Hashtag Chag Outro.
Wow. What an incredible, detailed journey we've taken today, diving deep into the complex and rapidly evolving world of stablecoins.
It really covers a lot of ground, doesn't it?
It does. We've seen how they've really transformed from this, niche crypto asset, mostly used by traders,
The original plumbing.
into what's becoming a truly fundamental pillar of global payment and financial infrastructure. And it's all being driven by these sweeping new regulations, widespread mainstream adoption by huge names, and some really profound macroeconomic implications.
And we've hopefully made clear those two distinct critical paths that are emerging from this regulated landscape. First, you have the regulated, non-interest-bearing payment stablecoins like USDC, PYUSD, optimized purely for transactions, for settlement, for moving value efficiently.
Digital cash, essentially.
Essentially. And second, you have the yield-bearing tokenized cash funds like BIDL, BNG, specifically designed as investment products within a compliant framework to absorb that market demand for earning a return on digital dollars. Understanding that split is crucial.
And all of this is happening against the backdrop of this intense global competition for digital currency dominance.
Yes, reshaping not just payment rails, but fundamentally altering national economic strategies at a pace that's really quite unprecedented.
We sincerely hope this deep dive has given you, our listeners, a clearer, more nuanced picture of this landscape. It's complex, it's moving fast, and maybe offered some insight into what it might mean for your own personal finances, your business, or just your understanding of the global economy you operate within.
So as we look out towards 2030 and beyond,
Yeah.
what does this all ultimately mean? Will the digital dollar, bolstered by this robust, regulated stablecoin ecosystem, manage to solidify its global lead in the digital age?
Or will that pushback, we discussed the acceleration of digital euros, maybe yuan stablecoins, create a truly multipolar digital currency world, genuinely challenging dollar dominance online?
And perhaps more personally, how might this emerging future shape your everyday transactions, the way you save, maybe even the cost of goods you buy online or internationally?
It's something to think about next time you swipe a card or make an online payment or send money overseas. This digital revolution, powered by these often quiet but incredibly mighty stablecoins, might be closer to fundamentally changing your financial world than many people realize.
Indeed. And I think it leaves us with a crucial question really for all of us, policymakers, innovators, users alike, as money itself goes increasingly digital at such speed. How do we collectively ensure we build a future financial system that maintains stability, protects privacy, and promotes economic fairness in what is clearly a rapidly evolving and deeply interconnected world?